Hey everybody, it's Seth for Everything Money. Paul and Mo are here. Welcome, Paul and Mo. We just got off an amazing interview, and we're here to do a reaction. We've done a couple reactions. We've got some nice positive and negative connotations around our reactions. Paul, they're saying it's off a smidge off brand. It's normally not like us to criticize.
The very little minority is saying that it's a smidge off brand and criticizing about it. The vast majority love it, appreciate the enthusiasm, appreciate me calling people out that I think are misleading investors.
Yeah, I agree. I answered some of the few people that said it's not really on our brand to criticize. It's actually, we've been thinking this for years. We were just being a little too nice.
By the way, it's
right?
exactly on my brand to criticize. That's what I do.
Yeah, you'll learn if you watch more of Paul's videos. You'll probably be criticized before this video is out. But Paul, you wanted to find someone a little more positive, and so we can all agree that.
No, I want to find somebody who was somebody that I agreed with more, and not somebody more positive, because the other two people that I bashed, Kathy Wood and Stockmo, are very overly optimistic, and that's a problem.
I see, of course. Yeah, this is Sven Carlin. He has, as he describes, the biggest value investing YouTube channel, which I guess in comparison, I don't know one bigger. And of course, just to show how popular value investing is it still a fraction of the subscribers that a lot of these hype YouTube channels have. But guys, I wanted to show you an interesting video today that Sven put out today. And it's about how his thoughts on how the market is overpriced, whether it is or not. And I was thinking he was just going to say the obvious, is what we've been saying for years now about how overpriced it is. He runs through some numbers. I had a hard time following it. Maybe you can. Okay. So here goes. Paul's going to react. Paul and Mo are going to react to Sven Carlin. Here we go, Paul.
Good day, fellow investors. Welcome to the channel where we discussed value investing with a long-term focus. If you like value investing and long-term, please click that like button. In this video, we're going to answer Lewis's questions about whether the market is overpriced, because when I analyzed the 30 components of the Dow stock by stock, you'll have the video in the link in the description below if you want to check that, then it was, from my 10% return calculation expectation, the whole Dow is extremely overvalued. So we're going to discuss.
So let's pause right there. Before the video started, and I have a lot of respect for Sven. I watch him. I read his book. I love him. I recommend people go follow him. But you initially started by saying, Paul, he doesn't think the market's overpriced. And already you have done exactly what other people out there are going to say. He doesn't say the market's, that's not what he's saying here. What he's saying here is, if your return expectation is 10%, which is the historical return,
go on,
it is overpriced. If your return expectation is 5%, there's a lot of opportunity. Guys, everything in this world is based on what return you can get. Everything. Hey, if you want a negative 20% return a year, nothing's overpriced. If you want a 0% return every year, nothing's overpriced. If you want a 5% return every year, okay, there's a lot more that's overpriced than not. If you want a 50% return, you'll never find a deal. Because remember, the present value of every investment is the return. The value of every investment is the present value of all the future cash flow. So if you just want to get a less return, then you're okay with that. So immediately off the bat, if you look at it, go rewind just like 10 seconds to the comments below. If you go look at this comments below, read below, I don't know if the Dow is overpriced. That will depend on what you compare it. For a 10% return, yes. For a 5% return, many are cheap. Well, let me ask you a question. Who here wants 5% return?
That seems pretty lower than bonds, wouldn't you say?
Not lower than bonds, but low. If I want a 0% return, that's where the market bounces. The market currently, the S&P 500 currently is basically valuing in about a negative 2% return a year over the next 12 years. So if you're okay with a negative 2% return, then the market's reasonably priced. So anyways, let's continue on. But I wanted to first say, the first thing you said to me was like, he's not saying that. I'm like, man, maybe I'm missing something then.
No, I certainly was, which is why I brought it up.
To check that. Then it was, from my 10% return calculation expectation, the whole Dow is extremely overvalued. So we're going to discuss whether the market is overvalued.
He just said that right there. The whole Dow is extremely overvalued.
Whether to be in cash waiting for a crash, and what do I think about index funds? So let's immediately start with talking about whether the market is overpriced. I don't think the market is overpriced. The market is just pricing in certain things, and whether it is overpriced or extremely cheap depends on you. Let me know in the comments.
What is he saying?
He's basically saying, what assumptions are you making and what return expectations do you have?
I see.
He hasn't said this yet. I haven't watched that, but if you're, I always say to people, if I was 80 years old and I had 8 nieces and nephews, 8 kids, a bunch of grandkids, and I wanted to leave all the money to them, I'd be buying assets a lot different than if I'm 40 years old.
Okay.
Because at that point, I want to focus more on quality of an asset versus return of the asset. I would buy Manhattan office buildings, apartment buildings, LA. I would buy overpriced buildings, but I know we're going to be around and raising rents consistently for a long
Interesting.
time.
Okay, we keep going because this confused me.
Whether you think it's overpriced or cheap. Now I'll give you the factors to determine that. So first, we recently analyzed every company of the Dow. You can find this template for download in the link in the description of this video, and you can play around with the valuations. Let's start with Apple, which is a great example. So we have here the list. For a 10% return, it is a little bit overvalued. Price 131. The 10% return is, let's say, 90.
What's he saying?
So he's saying the price is currently $132 a share, $131.94. If you want to get a 10% return based on his discounted cash flow model, you got to pay $91.24.
So it's overpriced.
Yes, that's what he's saying.
Okay.
If I go to the valuation table and I have a discount rate, which is my expected rate of return on the cash flows of 10%, strong buybacks, so a little bit of dividend, so I said growth rate around 8% there. But if I change the discount rate to 7, then the valuation already is much, much higher.
You get this, Paul? You know exactly what he's talking about?
So all he's doing here is changing his return rate from 10% to 7%. If you want less return, you're willing to pay more money, correct?
Yeah.
So all he's doing is going, okay, if you're okay with 7%, 111. Pay 111 for Apple stock. Ironically, it's still at 131 in this video. So it's still, the expected return over a long period of time is still below, over next 10 years is still under 7%.
Why would I only be looking for 7%? Is this someone
So that's the thing.
who would be happy with this?
Everybody in the world will say, no, I'm not getting 7%. You're just wrong. And I'm looking at going, okay, but wait. The present value of all future cash flows is how much you pay for a stock today. But they don't look at the business. They look at the stock price.
Yeah, the price.
And their comment is, no, it went from 60 to 130. It's going to go to 260. Well, what would justify it going to 260? That's the question.
I see.
That's the difference between a value investor and a speculator.
Okay.
111. If I change the discount rate to 6, then we are at 122.
Right on
with
track.
more exuberant growth rates on services,
And
with
that's the
a
other thing.
higher
Pause it.
terminal.
One of the things we're going to do with our stock analyzer tool for our software is we're going to allow you to do this, where you sit there and say, oh, I'm going to change my growth. Everything's about assumptions. Remember what Kathy Wood said? If Tesla gets 92% growth, then Tesla's a value play. Okay, 92% growth for how long? Forever? That's not realistic. But that's the thing. In very frothy and irrational times, we make really crazy assumptions. I always tell people, I can show you any piece of real estate is a value play. How? Or any stock. Just change the assumptions.
I see. The assumptions of maybe 50 years out as opposed to 20.
Not only that, 20% growth instead of 8% growth. Well, it's 20%
assumption.
likely. That's the thing we always get. That's why investing is an art. It's all these assumptions you're making. When I look at a piece of real estate especially, people will sit there and say, okay, maintenance repair is $300 a unit. Well, wait a second. It cost me $650 a unit. Why is yours $300? Well, we can do it more efficient. Okay, that's just an assumption you're making. Does that assumption turn out to be true? I don't know.
Okay.
Same thing here.
Multiple in 2030, not 20 by 30, then Apple stock is extremely cheap. 220 would be
Pause
the
it.
price.
What he's assuming is the terminal multiple being 30 times versus 20 times.
This
so
is
he
our pillar
increased
number
growth.
8, free cash flow? No.
This was
Multiple?
this is through free cash flow, it looks like.
Okay.
So he changed the growth rate from 8% to 12%, and then he changed the multiple from 20 to 30.
So that's an assumption he's making that Apple's going to continue to grow.
No, at a higher rate than he thought before. Instead of 8%, he's assuming 12%.
And that
instead of somebody paying 20 times free cash flow or whatever the cash flow multiple is, somebody's going to pay 30 times. Okay.
And so that's how he's showing Apple is in his mind.
And that's how people justify. They're like, oh, well, see, it was right. It's like, well, yeah, but if your assumptions are always crazy, eventually you're going to be left holding a bag.
Wow. Okay.
That's the point is a good value investor doesn't make extreme assumptions. They make very conservative assumptions that are still realistic and say, can I buy it for less than this price?
Okay, here we go.
Value for a 6% return with good growth rates and a price-earnings ratio even lower than the current one. 220 compared to the current 134. So no matter this huge increase in stock prices, if you look at from a 6% discount rate, then 129 compared to the current price, then Apple stock is also could be called cheap. And the same, if we go back, the same holds for all the stocks here of the Dow Jones. If you go lower with the expected return, then all these valuations change. Now the question is, why are expected returns, why does the market price in lower returns than 10%?
Because I'll tell you what he's going to tell you now. Interest rates.
Go on.
The argument was, well, I get 0% in my bank account, I might as well invest and get a 5 or 6% return or 2% dividend, so it's okay for me to do that. That's what he's going to tell you right now.
Is always comparing with the alternatives. If we look at the effective federal funds rate, we have had 0 for the last years. They tried to push it a little bit higher 2019, but they had to stop quickly because higher rates were no good. And the expected trajectory is for still a few years of very low rates and then slowly getting to 2%, but the long-term trajectory for the...
I absolutely love this guy.
Yeah, he really...
I mean, he's saying exactly what we say.
He's
just, he gets this.
Yes, he does get it.
He gets it. And that's it. It's just, that's what we talk about. You know, I look at Sven, I would love to do I mean, we only have 32,000 subscribers. I'd love to reach out to him. He literally has...
I've emailed him.
What, you have emailed him?
Yeah, hopefully some of his followers can help us get a hold of it.
He's 5 times larger than us.
He really
But I'd love to do I'd love to have him involved in our software too. I mean, he's just a smart guy. He's very rational. His book is wonderful. Get past the grammatical errors and probably the language barrier. His book is great. He talks a lot about return on invested capital, which you know I like a lot. Just, yeah, he's a very smart guy. He really gets it. I think everybody here who follows us should follow him as well.
Is 2%. If you can get money at 2%, and you can invest in businesses, as we have seen with Apple, that give you 6% at current price, 6 versus 2, stocks are ridiculously cheap. Actually, stocks are fairly priced if we have the equity premium.
The question becomes, and I've said this before, if you think interest rates are going to be this low for 50 years, stocks are probably okay. But if you think I just don't believe interest rates are going to be this low for 50 years. That's the issue we have. Everybody prices in a short-term price on a long-term basis, and I just don't buy into that.
That's the assumption game we have to play.
That's the thing.
Mo, do you watch Sven's videos?
Yeah. I have his book, read his book.
Oh, nice. Okay. Keep going, guys.
4%
value investing,
from
the book
2 to 6, then stocks are totally fairly priced. If interest rates stay low or develop as predicted. Also, if we look at the predictions for inflation, so we have had the spike now, but it is expected that things normalize and stabilize, of course, below 3, and then in the long term.
So maybe you can explain this to me, Paul. You know, he shows a projected inflation that looks nothing like
what we might think will happen.
That of the past, though. I mean, look, you're showing this roller coaster up and down, and then for some reason it's going to plateau.
How far back is that chart going? I don't even see how far back it goes.
Yeah, I can't see the bottom of what he's doing here, but
I mean, for the. Oh, wait a second. I know that's the last. It's probably 2000. It's probably going back to 2000.
Yeah, but to me, it seems silly to expect this plateau when the last 20 years have been up and down like a crazy train here.
Yeah, but
you have to make some sort of assumption.
Well, CPI inflation, yeah, that was a big spike there. Remember, everything about investing is assumptions you make. The question is, are your assumptions reasonable, aggressive, and unreasonable on the other side? You just have to, that's the thing about investing that makes it so wonderful and fun, is everybody has a different style. If you want to look, I believe the world of value investing is make reasonable but safe assumptions. You're going to still be wrong, but make reasonable and safe assumptions. And if you apply that to 10,000 companies, you'll find the 20 or 30 that fit your model.
I see. Okay, interesting.
Around 2%, 2 point something. With low inflation, interest rates can be kept at 0 or very low.
Pause
Economy doing...
What have I said before? When inflation starts to go up, the first thing you're going to do is raise rates. That's how you fight inflation. That's it. So what he's sitting there saying is, if we have this low inflation,
Yeah.
we can keep interest rates really low.
Yeah, just a big balancing act.
Fine, we'll keep interest rates really low.
Okay.
The market is fairly pricing what's going on, the current expectations. That is what the market always does. So whether to go into cash, the answer is with you. If you like 6%, what's wrong with 6%? With great companies, there will be ups and downs, but that's investing in stocks. Then the market is fairly priced for 5-6%. Nothing wrong with that. If we look also at valuations,
How so?
Well, I believe that you should be patient for better times to buy, because there'll be a time when prices are factored in, assuming 15% returns, like the early mid 80s. I mean, I just feel like, remember, we're talking about individual
is he saying
stocks
versus having cash sitting around, I think is the premise.
Maybe so, but
maybe so.
I believe that if you're saving for the long run, you should be saving in ETFs and not worry about valuations. If you're trying to pick your own stocks with a portion of portfolio, be patient. That's what I believe.
Yeah.
But Sven's saying, listen, if you can buy a company like Apple at 5 or 6% return, maybe that's okay, because, hey, it's still a great company. Very well could be right. I just choose for myself personally, what I'm trying to teach people is, hey, if you're trying to really understand how to make outsized returns, 5 or 6% doesn't do it.
Mm-hmm.
So be more picky.
the Dow Jones has a valuation of 30. That's a return of 3.3% from the earnings yield. If we add 2% of economic growth, that's a 5-6% return. 1% inflation, 2% inflation, 5 to 7% returns. Nothing bad. And if we compare this to the last 20 years, also historical valuations, those that invested in the S&P 500 in 1999 still did 6% returns, which are great returns, especially compared to cash or inflation.
Pause. Remember one thing though, Sven.
Go
That
ahead.
6.1% return is going into a massively overpriced market still. So he's comparing the return from a massively overpriced market to another massively overpriced market. So even though you invested in at 2000 to now and you got 6.1%, he's right, it's 6.1%, not terrible, but it took going into another massively, many would argue, way more overpriced than 2000 to even get that 6.1% return. So for everybody in 1999 2000 who are saying the same things as today, this is incredible, it's awesome, it's a new way of life. It's like investing today and hoping that 20 years from now, we get an even more overpriced market to even get the 6% returns. I do disagree with his way of looking at it here, because it's assuming what he forgets to comment is it took a massively overpriced market getting to even more massively overpriced market to even get an okay return. That's not safe. So I'm not saying he's saying that that's good, although he did say it's pretty good. But the thing that he's leaving out there is that major caveat, which is overpriced market to another even more overpriced market. And that's not, when you make assumptions, you don't make assumptions based on best case scenarios always happening. That's not good investing. That's not a good way to live in life in general. Do you know what I mean? Mm-hmm. If you got married, assuming you're never going to get in a fight, you're going to be very disappointed on the honeymoon, right?
In Mexico, luxurymanzanillo.com. What's the new website, Paul?
Luxuryei.com.
Go luxuryei.com. Go to Mexico for your honeymoon. Here you go.
Investor did, according
Nestor will
to
be
JP
Nestor will mediate your first argument as a married couple.
Yes, that'd be beautiful.
Morgan. So 6% is great for the average investor. Why did they underperform the market? Because
Pause.
Why is he saying it's great for the average investor?
Because look at the average investor there.
Oh, okay.
The average investor did 2.5% over the last 20 years. That's the thing that everybody has to remember. Following the S&P would have gotten you 6.1, but the average investor bringing their emotion into it and selling at the right time and buying at the wrong time got them 2.5%.
Got it.
Wow, that's incredible.
Yeah. Which, by the way, inflation is 2.2, so you basically only made 0.3% a year on your buying power.
Yeah.
Go ahead.
Always try to time the market, to go into cash now. The stock market can double in the next 5 years. If interest rates stay low, as Warren Buffett says, stocks are still ridiculously cheap. What will happen with interest rates? Nobody knows, but you have to see not what will happen with interest rates, not what will happen with stocks. You have to see how the dividends, how the earnings yields, how the business fits your long-term returns. Everything else has to be left to whatever will happen in the future. But if you go to time the market, as many others have tried, then you can expect worse
Go ahead, Paul.
I was just saying, as many have tried.
Right.
Oh, I see. Keep going.
returns on average over the long term. Because
Yeah, I'm not going to get
people
2.5%.
said, okay, I will sell here.
The reason why people get 2.5 is because they're too scared when times are low. When times are low, I'm frothing at the mouth.
Mm-hmm.
As we saw last year. Do you know what I mean? I was buying, how many things did I buy in March, April, May? I was frothing at the mouth.
Mm-hmm.
So I'm not worried. Like the average investor should be worried. Me, I'm just like, okay, I'm down right now. Okay, fine. Fine by me.
In 2000, and when it crashes, they always fear it will crash more and more.
That's
And
the average
then they
investor.
buy when things recovered. I've spoken to a colleague when I was teaching in the Netherlands. He sold everything in March 2009. He had a big portfolio, was down more than 50%.
Complete panic
So
sells.
really big loss. He sold everything here. He came back in the market 2015. On valuations, yes, the market is
2015.
overvalued. We are now at
We're seeing
levels
so much money
never
dumped in the
seen in
market
history.
right now.
Say it again.
That's why we're seeing so much money put into the market right now.
You guys,
Ah.
if you ever look at the money inflows in the market,
It's incredible.
it goes high when stocks are very high, and it exits. People take their money out when stocks are very low. That's human nature.
Yeah, it's panic selling.
Then there's the opposite, what I do. I'm scared when stocks are very high. I'm very excited when stocks are very low.
Except for the dot-com bubble. But so was the market overvalued in 2012 if you compare to history. So you never
that's
know
true.
what the market will do next. You have to see how the market fits you. If I look at what cash gives you, it was 6,000 in 2000, so there was another opportunity, 6% savings account returns in 2000. Now we are at zero practically. So of course, comparing to alternatives, comparing what you get in the bank over the last 10 years, stocks are again cheap. So investing is about finding the best vehicle for you, whether you're going to sit in cash. I have no cash, as I made in this other video.
Yeah, so I have friends that, we have mutual friends that they keep their money in high interest bank,
What's high interest?
Yeah,
then?
what's high interest mean nowadays?
like
I mean,
1.8.
I was looking. Yeah, I was looking at the 3-month Treasury today, 0.01.
That was what he just showed. $100 and 100,000. It's
Literally nothing.
It's 0.01.
It's 0.01 as of this.
Yeah, that's 0.01.
Today. Yeah,
Wow.
0.01.
Okay. Keep going.
I have really no cash, so because the risk and reward of what's going on, of the money printing, for me, I can accept the volatility, reinvest the dividends if we have a crash on
Pause.
higher interest rates.
Mm-hmm.
Listen to what he's saying. He can accept, and he's a disciplined guy. If stocks go down in half, he's okay with that. The average investor is not. The average investor is not okay with that. I'm okay watching the market double in the last 5 years and me being out of stocks. Okay, fine by me. Because I didn't get them. I didn't understand them. Okay.
Yeah.
Nobody else is able to do that. It's the FOMO thing we're talking about.
Mm-hmm. I have it too.
And that will likely increase my long-term returns. But for as long as the Fed keeps printing money, cash is trash. And that's something also to...
Is that true, Paul? Cash is trash?
I mean, he's assuming a long-term period of holding cash. If you hold cash forever,
Yeah.
as they print more money, you're going to be losing buying power year in and year out. Absolutely. Of course, I'm trying to justify my own decisions, but I have a hard time believing at the age of 45, I'm not going to have a significant investment in stocks, if not 100% of my money in stocks with my businesses and real estate. I'm not worried about it. We just talked about today. I'm going to be 40 in July, right? I've got 60 more years to live. I'm going to look back at this and laugh and go, okay, so I hurt my returns by 0.3 or 0.4 or 1% a year. Okay, I still made a lot of money. What do I care?
Yeah.
keep in
I can afford
mind.
that.
Yes, you might time the market, but what if in the next 5 years you stay in cash now and nothing happens? Also
Fine
keep in
for
mind
me.
such considerations. And on index funds, so we analyzed now the Dow, and it did really well over the last 10 years and over history, and it will keep doing so. Maybe we'll have a lost decade like we discussed in another video. Maybe we'll have something
I think
else.
we're going to have a lost
Maybe
decade.
it will double, and then we'll
We had a lost decade from 2000 to 2010.
Yeah.
What was the Dow in 2000? Look at that. Do the math there.
10,000?
10,000.
And then go to
11,000?
2010.
Oh, wow. Lower, obviously.
No, 2010. A little bit more to the right. About the same.
Yeah, about the same.
Last
wow.
decade.
No.
You got dividends. That's it.
Wow.
So that's what I'm saying, guys. And what was 2000? Really high valuations.
I see.
The more you pay for something, the less return you're going to get in the future. That's it. It's just math, guys. There's no way of arguing that. If you think that paying more for something will get you a higher return, then I will pay you $10 billion for whatever you have to sell, because according to that, then I'm going to make more money. Doesn't make sense logically. Although a lot of things don't make sense logically.
That's also something. But when it comes to investing in businesses, I think you have to see, okay, what am I buying now? Am I buying it? Why? For the dividends, for this, for the potential growth, for the higher interest rates. So if you buy, let's say, the Dow, then you have a likely return of 5, 6%, 7% likely, with ups and downs. If that is good for you,
that's the important
then
part
great.
to repeat, guys. If you invest right
7%
now,
is great.
All right, go ahead.
if you invest right now for the next 50 years, you'll probably make 8 or 9%. But are you okay losing 50 or 60% several times along the way? If you're not, then you should get out of investing, because it's going to happen. That's the point. Everything will do well over. It's not a straight line. If it was a straight line, we wouldn't have this big rush up, right? That's just the way it is, guys. There's ups and downs for everything.
Or you're going to make that 2.5%.
The only thing I don't like about this video, correct, is I think it's making it make people think like, oh,
yeah,
this is fine. Everything will be good. I'm going to make 5 or 6%. It's not a 5 or 6%. It's not 5 or 6% year in, year out, right? It's up 20, down 10, down 15, up 30. That's just the way. Now, for all of you out there who see it, you're kind of like, well, the last 11 years have been all up but 1 year. And that's true. And that's why I sit there and say, guys, this isn't normal. This isn't the way that these things should be.
For 95% of the population. I strive for higher. As long as I can find higher, I'm happy with that. And then also when it comes to index funds, I think the expected return is key here, because you can compare, okay, expected return 5%, let's say, with potential of 50% crash versus paying off my student loan of 5%. That's something you have to put into perspective.
Now, if you want to be active about it, we talk about paying off debts and having more debts. If you're paying 5% of a student loan and it's hanging over your head and the projected returns are 5%, and it's a guarantee on paying off the student loan, pay off your student loan. You're giving yourself a 5% return. Why take the 50% drop?
Okay.
Into perspective when it comes to index funds. So see how all of this fits you. I think the market is fairly priced. It can go up and down. So that's something that we will see in the future. And the key is to find the vehicles that work for you. The market is
here's the point.
Market.
I like him a lot. And I still have things where I go, well, I don't necessarily agree with this. And guess what? He'd probably like me a lot. And he'd be like, well, I don't really agree with this of what Paul says. But, you know, it's just, you got to find your own style. I just don't.
It's what speaks to you and what doesn't speak to you.
Okay, so Paul, after you see Sven, what would you say to our viewers or people watching you for the first time?
Well, so people find us because some people just hate what we say and they say, you're wrong, you don't understand. Some people find us and go, oh my gosh, this finally speaks to me. There's a reason why we're creating this channel. We created the software you can sign up with on patreon.com, get our software for life. It's just to help provide a process, because at the end of the day, there will be a bear market. And history has shown the bear market will be very bad. I learned from a very bad bear market. I was like you out there when I sat there and said, nope, you don't get it. It's growth. It's technology. It's totally different. And then when it didn't turn out that way, I was like, oh crap, what did I get wrong? The difference now is I've been wrong the last few years, but I don't know. I don't look at it going, oh my gosh, I've been wrong. I'm like, okay, this is just part of the process. I realized when I was wrong when the hype didn't work anymore. Because when the hype stops working, there's no other way to make up for it. But to me, it made more sense to understand process and fundamentals, and that's what we're teaching on our channel. And for those of you who criticize us, I get it, 100% agree. It doesn't make sense to you now. But when the market does fall 50, 60, maybe even 70%, which you might probably think is crazy, just remember our channel, come back, we'll be preaching the same things and we'll teach you the same way. And you'll be able to get our software, which gives you the fundamentals, will give you exclusive access, etc., to be able to learn more so you can make more money.
That's our take on Sven Carlin. We appreciate you guys watching the video. Obviously, if we're big fans of him, go tickle his thumbs up as you tickle ours on the way out. And again, follow Trader Mo in the morning every 9 a.m. Eastern. Mo goes live talking to our Bid and Ask Nation, those day traders, momentum traders. And Paul and I, Mo, always go live Tuesdays at 1 p.m. Eastern. Thanks for the support. We love you as patrons out there.
And we're going to start doing a Patreon-only live stream on Thursdays.
I'll be darned. Is that so?
Yeah.
I'll be darned. News to me, Tim.
No, we talked about it with you on the air.
Love ya. Bye, guys.